one in a series of Bitcoin's big pullbacks. Historically, the big pullbacks were 60%. That's what we saw in 2022. That's what we saw in 2018. That's what we saw in 2014. If we stabilize here at around 30%, I know that sounds like a lot, but for Bitcoin, that's relatively modest. And I think it shows this is increasingly owned by institutional investors who will step in if the price falls too much. That wasn't true even a few years ago, but now you have a large swath of institutional investors who have become almost value buyers in the Bitcoin space. It means lower volatility and I think higher prices long term.
October 2024. Bitcoin was trading at all-time highs. The bulls were running, the moon was in sight, and the sentiment was electric. Then, at 5 p.m. on a Friday, a single announcement regarding 100% tariffs against China hit the wires. In a matter of hours, the market didn't just dip, it evaporated. $20 billion in leveraged investor money vanished in one of the largest cascading sell-offs in the history of crypto. For the critics, it was the same old Bitcoin, a volatile, unreliable asset prone to crashes. But for Matt Hougan, the CIO of Bitwise, this wasn't a death knell. It was a hangover, a necessary purging of the system that set the stage for something much more profound. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
Bitcoin had a fantastic year up to that point. It was trading at all-time highs. And then if you remember, at about 5 p.m. on a Friday, Trump announced 100% tariffs against China. The market is relatively illiquid at that point. There was a lot of leverage in the crypto system that moved prices down, and we got a cascading sell-off of leverage positions, the largest in Bitcoin's history. About $20 billion of leveraged investor money evaporated in the matter of hours. And for the next 3 months, we sort of worked off the hangover from that. People were worried that a market maker was impaired. They were worried that crypto hedge funds were winding down. And so the market retracted from there a little bit. But big picture, and I'm sure we'll get into this, the long-term trends are good. In fact, today is an incredible day with this challenge to Fed independence to be talking about Bitcoin. Bitcoin is the ultimate hedge against that sort of insanity and potential fiscal mismanagement. So yes, it was a difficult time post-October, but I'm actually increasingly optimistic that we'll make up for it and then some in 2026. Leverage builds up in a couple of ways. One, there are large futures exchanges overseas where retail investors can take out extreme amounts of leverage, 10x, 50x, 100x. So you see that build up. There are also a lot of hedge funds that are using futures and options from CME and other venues to take on leverage positions. And then, as you mentioned, people with existing Bitcoin positions or existing crypto positions can borrow against that and lever themselves up. We see this in traditional markets, of course. It explains actually some of the biggest pullbacks in traditional markets. Too much optimism builds up, too much leverage builds up, and then it gets washed out of the system. And after a while, you reset and start to move higher. That's what we're seeing right now. Leverage is relatively normal at normal levels now, so we're not at that extreme risk. But we had gotten maybe over our skis in October. Again, we were at all-time highs. I do think the fundamentals behind Bitcoin are strong now. So a leverage buildup, a washout, and now we're in the bottoming process. One in a series of Bitcoin's big pullbacks. Historically, the big pullbacks were 60%. That's what we saw in 2022. That's what we saw in 2018. That's what we saw in 2014. If we stabilize here at around 30%, I know that sounds like a lot, but for Bitcoin, that's relatively modest. And I think it shows this is increasingly owned by institutional investors who will step in if the price falls too much. That wasn't true even a few years ago, but now you have a large swath of institutional investors who have become almost value buyers in the Bitcoin space. It means lower volatility and I think higher prices long term. Remember, crypto for its first 15 years was primarily held by retail investors, by the type of investor you might associate with Robinhood or other sort of fast trading platforms. But now institutions are coming into the fore. Now Harvard Management Company's largest single liquid position is a Bitcoin ETF. Now you have sovereign wealth funds owning Bitcoin ETFs. You have 10,000 plus financial advisors owning Bitcoin ETFs. And those investors act differently. Those investors rebalance, which is to say, when the price falls, they buy more. When it goes up, they sell. That's different from the historical crypto investor who was more momentum oriented. They would sell when the market fell and buy when the market rose. What that's meant is lower volatility. I think lower drawdowns, right? You're not going to see 60% anymore. It's a maturing asset. That's what we're seeing in the market. There's actually never been a period in Bitcoin's history, if you held it for 3 years or more, where you didn't increase your absolute and risk adjusted returns. It's a fantastic ingredient for portfolios. It has high historical returns. It has low correlations to stocks and bonds. It's a little volatile. So if you add it in and then rebalance, you harvest some of that rebalancing premium, some of that diversification benefit. So, that's what's driving these allocations. And again, we already have 2 endowments. We have two Ivy League endowments. We have Harvard and Brown who have allocated to Bitcoin. It could sweep the table. It is just a great asset for institutional investors because it has these characteristics that are hard to find. It's hard to find something that's not correlated with stocks and bonds and is still liquid and still has appreciation potential. That is Bitcoin in a nutshell. And that's why we see this huge surge of institutional adoption. You're already seeing it in IRAs. So you're already seeing it in retirement accounts. 401k providers are slow to move, but you're right that the Trump administration has sort of removed what was effectively a ban on Bitcoin from 401ks. You're seeing that across the board. Previously Vanguard didn't let its customers invest in Bitcoin, even in their brokerage accounts. They've relaxed that ban as well. I find all these bans to be ridiculous. This is just another asset. Does it go up and down? Absolutely. Is there risk in it? Absolutely. But it's actually less volatile over the last year than Nvidia stock. And you don't see any rules about banning 401k providers from offering Nvidia stock. That would seem ridiculous. Bitcoin has this sort of legacy that it's getting over. So I don't know if the 401k providers will get all the way to the point of actually putting it in this year. These are very slow moving institutions, but we're moving in that direction. And eventually it'll be normalized like other assets, which is how it should be treated.
While the shift from the hostile SEC of Gary Gensler to a more positive regulatory environment was a massive win for crypto in late 2024, it isn't enough for the big banks. Hougan emphasizes that Wall Street hates uncertainty. A friendly regulator can be replaced by a hostile one in the next election. This is why the Clarity Act is the most important piece of the puzzle. If Congress passes a firm regulatory framework, it provides the all-clear signal. It ensures that the rules of the game won't change for the next 20 years. Hougan predicts that the passage of this act would send Bitcoin, Ethereum, and Solana to new all-time highs almost instantly. It allows institutions to build long-term infrastructure without fear of a regulatory flip-flop.
What is the Clarity Act? Why is it important for retail investors and institutional investors? And what might it do in terms of price appreciation or if anything at all, for Bitcoin?
Yeah, I think it's key to the entire crypto ecosystem, whether this has a great year in 2026 or whether we have volatility. If we see the passage of the Clarity Act, I think we'll see Bitcoin, Ethereum, Solana, the largest crypto assets, trade to new all-time highs. And here's why. You may be aware that we've gone from a very difficult regulatory situation under the Gary Gensler-led SEC to a very positive regulatory orientation under the Atkins-led SEC. That's been great. That's one of the reasons crypto rallied after the Trump win in November of 2024, is that we've moved into a positive regulatory environment. But unless we get legislation through Congress, that regulatory environment could flip, right? If we have a change in administration, we could go back to a harsh regulatory environment. What this industry needs to thrive long-term, what it needs to attract institutional capital to see Wall Street continue to build on it, is a firm regulatory framework where everyone knows this is how this industry is going to be governed for the next 10, 20 years. Then we can really build. That's what the Clarity Act would provide. Again, if we get it, it's sort of the all clear signal. I think it's going to be a great year in crypto. If we don't, and Washington is always unpredictable, then I think there could be more volatility ahead.
There's going to be more crypto ETFs on the way, potentially 100 more crypto-linked ETFs on the way. Why do we need more? We seem to have plenty of them out there. You offer plenty of Bitcoin and other crypto-backed or spot-related ETFs. Why do we need more in the retail or institutional sector?
Yeah, look, some of these ETFs won't be worth buying. That's true outside of crypto as well. As you know, there are thousands of ETFs. Not all of them are good, but there are still big categories that are just developing in the crypto ETF market. You know, the biggest ETFs are single asset ETFs like Bitcoin ETFs or Ethereum ETFs or Solana ETFs. I think many investors will be best served by index-based ETFs. You know, we invest in indexes for the majority of our equity and bond portfolios. I think the same will be true in crypto. So there's some very interesting areas around index themes, around risk mitigated exposure, around thematic exposure to high growth areas like DeFi, stablecoins, and tokenization. Investors like to use ETFs as the major way they invest. There are still big areas of the crypto market that aren't push button easy to access. I think you'll see ETFs that offer that exposure, starting first and foremost with the growth of index-based exposure. I think that's a huge, $10, $100 billion category eventually.
If you look back at almost any year, except for a couple of those big bear market years, it's been setting new highs. But what do you mean by the 4-year cycle?
Yeah, so historically, Bitcoin has moved in this 4-year cycle of 3 big up years and a pullback year. I mentioned earlier we had big pullback years in 2014, in 2018, in 2022. The next number in that sequence would be 2026. So according to the 4-year cycle, this would be a negative year for Bitcoin. Why do I think that won't happen? Well, the reason we had those big pullbacks in the past on that 4-year cycle were two. Bitcoin has this halving that reduces the supply every 4 years. And at least for 2018 and 2022, we saw interest rates spike, go way up. What I'm looking at in 2026 is the halving is no longer very important. There's just not that much more Bitcoin being produced. And interest rates are heading down, not up, right? Particularly after this news regarding Jerome Powell. So those forces are now weak. And at the same time, we have these huge positive forces, institutional adoption. We just saw the largest wirehouses, Bank of America, Wells Fargo, UBS, Morgan Stanley approve Bitcoin ETFs in Q4. We have regulatory progress. Those are decade-long trends. And I think the bullish trends are just more powerful than the historical 4-year cycle trends that pulled us down. In fact, with interest rates, they're now moving in the other direction. So I look at this market and I think it's an incredibly attractive market for Bitcoin. It's one of the few times in its history where I think the fundamentals are ahead of the price. Usually the price is running ahead of the fundamentals. The fundamentals in Bitcoin right now are very strong. The price is depressed from that Q4 pullback. I think it's an attractive entry point for long-term investors. Look, prediction markets, I'm not the first to say they're on the rise. They had a huge run in the 2024 election. Many people thought they wouldn't get back to that till 2028. But obviously, we've seen massive growth, right? They're now on all the awards show. They're predicting economics, etc. The thing that's unique about Polymarket is it's uniquely suited to the crypto audience. That's where it's born from. That is the underlying driver of how it works. The crypto native audience is the leading edge of this sort of cross of social gambling and exposure. They're used to it. I just see that as a runaway growth trend. I don't think prediction markets are going away. I think they're strengthening. And I think Polymarket, along with Kalshi and others, is sort of has a unique lead in that space. I think it's emblematic of the new type of capital markets we're going into that's more online, more social, more speculative at the edges, right? Still maybe long-term holding at the core, but there's a lot of speculative activity on the edges. I think Polymarket is the tip of that spear. So this seems like an easy prediction, an easy win for us.
The message from Matt Hougan is clear. Don't let the short-term noise of a leverage hangover distract you from the institutional transformation occurring beneath the surface. Bitcoin has survived the 100% tariff shocks and the $20 billion liquidations. It has emerged as a maturing asset that is less volatile than Nvidia stock and more attractive to Ivy League endowments than ever before. We are moving toward a world where Bitcoin is a standard 401k option, a world where Fed insanity is met with a digital hedge that is globally recognized and liquid.